Hello and welcome. Thanks for joining us today. Starting right on time. Going to share with you today that something that's pretty near and dear to me. It's a lot of how I've built this business throughout the years, serving our clients that are at usually public institutions or government institutions, professors, teachers, police, fire, etc. And going to share with you some of the important things about your full 3B, deferred comp, some of the other plans that may be at the universities like ARP, ORP, etc. So thanks for joining us today. We're going to go ahead and dig in right away so that we have time for questions. So let me go ahead and we'll start. So obviously, as I mentioned, we're going to explore some of the more advanced strategies, best practices, maybe even some case studies to get you the idea. And don't be put off. I mean, if you're younger or just starting, I know some of these numbers will seem out there, but you can use a lot of what I'm talking about to any extreme or small amount, and it's going to make a difference. All right. So let's look here. So I always like to do this, something I like to do from the military, bottom line up front. So I want to help you understand retirement plans because through the years of talking to many of my faculty, staff, et cetera, that I've worked with, let me go ahead and just move these. When I explain it in a certain way, it kind of changes the paradigm a little bit for some people in terms of how they think about their retirement because they think it's so different than the traditional. And in some ways, it is unique and has some opportunities that others don't have, but it still falls into an understandable thing that you can relate to the privatized 401k kind of Social Security paradigm. Want to look at some tax maximization strategies because when you're using these plans, I mean, they are to save for retirement and what's so, but the government a long time ago decided to give tax preferences to kind of incentivize people to save for their retirement. And I think part of the main reason they did that is because they wanted to have people save up enough to where they're not going to be dependent on the government, et cetera. And of course, I think over the years they've gotten accentuated, just because of lobbying and, the wealthier side of people definitely want and need tax breaks more from a percentage of how much taxes they're paying. Then we're going to get into looking at, what is a brokerage window? How does it work? How do you use the features of it? And avoiding some of the most common mistakes that people can fall into. And then just looking at some of the ways that you can build custom solutions. So a custom kind of system for yourself that fits you, that'll work well for you, and overcome some of the shortfalls that a lot of the retirement plans have fallen into these days. So looking at this, it really depends on who you work for, right? And it's going to be different from state to state. And even inside some of the states, it's going to be different whether, your staff or your faculty, or you work for the fire department or police department, or straight in the government. So you're going to have a little bit different setup of these things. So I'm going to mention some of them and, where they fall. And so generally, I could have put pension here too, right? We could have put, pensions like in Ohio, we have OPERS and state teachers, so STRS and SERS. And then the ARP here is the defined contribution side if you opt out of the pension. And then other states like Texas and what's all have ORP, so instead of alternative, optional. And then some places you'll see they'll just straight up call it 401A. That's the kind of the section of the tax code that a lot of these fall under. And a lot of these things are going to be very similar, but they are primary retirement plans. And you'll see a lot of the ARP, ORP more often in university setting rather than K through 12 or government. Full 3B plans, so if we were going to say, hey, your pension or your alternative to that pension, alternative retirement plan or 401A is your primary retirement, it's like Social Security, right? In most cases, better than Social Security, but like Social Security. And then you have a 401k, right? In the private world, you have a full 3B. So if you work for a nonprofit, you have a full 3B. It's your equivalent 401k. One of the main differences are that you can't have stock inside of it, which makes sense because full 3Bs don't have stock, right? They're nonprofit. And so it is a difference. But you can think about it just like that. Your full 3B is your 401k. Now, that's nonprofits. If you're government, you have a 457B, which is also called qualified deferred compensation. And if you usually, if you're a firefighter, policeman, you work for the state government or local government or what, so you're just going to have a 457 or deferred comp. Now, if you are a state school, like a K through 12 or a public university, then you very well may probably have both. Okay, you have full 3B and 457. Okay, and so that is a unique thing to have, to where you have two supplemental. So we'll call this primary, and these are supplemental retirement plans. Okay, so what now?
Your slides aren't up.
Oh, they're not up? Oh gosh, let's see. Sorry about that, everyone. Thought we had that going. You didn't get to see my beautiful slides. So let's go back. So really, when I did the bottom line up front, this was all the slides where this is my pretty AI picture that I made for you guys. And then this is where we were, whereas I was explaining the plan. So you didn't miss too much. Hopefully you are following me, and apologize if you missed on that. Let me scoot this out of the way. All right. And so again, supplemental, primary. Okay. And then there are other plans. Now, this is where either you need to do some reading. Sometimes HR can help you, but a lot of times they may be able to give you the documents, help you sign up, tell you some things about them. But when you start getting out of just the normal plans right here into the more obscure, some plans, like probably one of the ones that I see that's kind of the weirdest from the universities and stuff that I work with, OSU, Ohio State, has a 415M plan, which is kind of an additional plan for highly comped employees that go over the maximums of some of these over here that they can offer. And it's got some quirky rules in terms of how you enroll and how much goes into there, and then what happens to it when you separate from service. Sometimes you work, say, for Children's Hospital or what's so. Just the way that they label the plans will be a little bit different. So you'll have a full 3B where all your extra money goes, and then they'll have something that just says DC plan or what so. And that is kind of like where the employer will put in their extra money. But in that circumstance, they still work with Social Security. So you have Social Security plus a DC plan plus a full 3B. So again, we help our clients with a lot of these things and understanding and optimizing, but I want you to have a layout. Most of the time, you're going to have primary, which is going to be, your pension or one of these 401A type plans. And then you're going to choose whether you want to enroll in one of these two or both. Okay. So let's keep moving. Plan types. Okay. So we already started talking about this, but I, again, want you to see the layout of these and talk about a couple more things. So defined benefit plan are pensions and Social Security, right? Things that are defined by what you get in the end. They're usually based on some type of formula. So the state pensions are kind of the easiest to understand. So again, I'll give you, I'm in Ohio. This is where most of my clients came from, but I've got university or K through 12, government employees, military, all over the country. But Ohio is like our main thing. So in OBRS, its formula is 2.2% times the number of years that you work in the system times your final average salary. Now, there's some nuances if you retire earlier and, depending on what survivorship you want for your spouse, et cetera. But that's it. It's based on a formula. It doesn't matter if you started as a janitor for 25 years and then ended your last 5 years finishing up all your schoolwork and everything to, get your PhD and become an associate professor for the last 5 years and end up getting way higher. It's going to be based off that formula. Okay. And again, sometimes there's rules. I'm not going to get into all of them now, but I'm giving you an example so you understand the difference between a defined benefit, which is defined, by what you get in the end, not how much you put into it or how much it grows into. It's based on that formula. versus defined contribution, which all of these are defined contribution. So defined contribution is defined by how much you and the employer put into there, how much you grow it into, so your rate of return matters, and then you decide how to take it out and use it and hopefully not run out of money. So pensions are defined benefit, and more often you're seeing that there are the ability to opt out and do something that's alternative or what, so like these programs right here. But you are fundamentally switching your retirement from that defined benefit to a defined contribution, and they each have pluses and minuses. We do a good job of helping people evaluate that when they have that decision, but you got to be on top of it. You usually only have like a couple 4 months when you're first hired to decide, and most of the time it's irrevocable, which means that unless except in a couple esoteric rules or situations, if you elect this or you get defaulted into it, you're not switching to this. Okay. And so it's important to take the time to figure out what's best for you. Vesting makes a big difference. And depending on how old you are, when you're electing into here, when your retirement is going to be, and how aggressive or conservative an investor you are, all of these important considerations that would possibly make you choose one versus the other. And so you got to go into one of these. So primary, you're going in. And half the states, approximately, is a little bit less, will do something like this, where their pension or this replaces Social Security, and then a little bit more than half, they'll have some kind of pension that works with Social Security. So if you are in Michigan, then you'll have pension plus Social Security. If you're in Ohio, you only have the pension or ARP. If you're in federal service, then you're going to have pension plus Social Security. Okay, now if you're way older and we're in civil service, that might be a little bit different, but pretty much everybody nowadays that hasn't retired already and is trying to figure these things out, that's not going to be the case. And then you need, everybody knows you probably need to save more than just what the minimum is. You're going to get these plans. And I already explained a little bit, who they're for, when you would get access to them. But you also have the ability to do pre-tax or Roth. So pre-tax means you get a tax deduction, and then it grows tax deferred, and then in the future you pay taxes on it when you take it out. And then Roth it's just like you got paid it in your checking account, except it's going to go in your retirement account. And if you follow all the rules, you get to grow it tax-free and you get to withdraw it tax-free. Okay. And then you got to decide, kind of which one is better for you if you get the choice of both, or if you are just in a nonprofit, you're going to use the full 3B. If you are just working for the government, you're going to use the 457. If you are a nonprofit governmental organization, then you got to choose which one. These two are not like plans. Okay, so you can actually do both of them and max both of them out. I'm going to show you an example of that, and it's pretty cool, and they're stackable. Non-like plans are not stackable. Okay, so 403B, like I said, is kind of like the nonprofit's equivalent to 401k. If you're in federal service, the TSP and a 403B are like plans. And I have people that are like this. I'll give you an example. I've got doctors and stuff at UC that have part of their pay that comes from the VA. So that's federal, right? They get the federal pension and Social Security and the TSP. And then they work for the university. And so the University of Cincinnati is a public university. So then they have a 403B and a 457B, and they either went into the pension or chose the ARP. Okay. And so if they maxed out their TSP, they couldn't put any more into their 403B. Okay. Because they're like plans. You can't do both. But that person that maxed out the TSP is still allowed to max out the 457. So that's what we're talking about, like and not like plans. Okay. And so that is a unique feature of someone that works for a governmental nonprofit, is that you actually get double the deferral capability that we do in the private world from this type of plan. So plan limits, you can kind of see here. So the 403B and deferred comp, if you're under 50, is going to be $23,500 for 2025. They raise it usually, unless inflation's super low or zero. They're going to raise it every year. And now they have the catch up. It's $11,250. And it's kind of weird in the fact of how they're doing that now. You get a plus 50 catch up. And then there's an additional catch up if you're between the age of 60 to 63. They can go all the way up to $11,250. So if you Google these things for exactly how old you are, get an advisor, like us will help you make sure that you're getting the max of all that you can. Now, when you're looking at these type of plans and kind of your ARP and ORP, when everything gets added up, then you have this total limit of 70,000. So even though you can only put in this much, if the employer wanted to put in more, you could. In 403Bs and in 401Ks, there's also the ability to do what's called after-tax contributions that are allowed to go all the way up to this. And you may ask, why would you do that? I'll give you an example of that later. And then you have your individual retirement accounts, which you do on your own. These you have to do through your employer, okay? If you're self-employed, there are other things, but again, we don't have enough time to go over all of that in this one. This one is, we're really focusing on the 403B and 457, okay? And let's keep going. So let's look at a couple kind of case studies here. So I know, again, some of these numbers are bigger, but I really want to accentuate to help you understand a little bit more of the extreme of what you can do. So in this circumstance, we're going to stack retirement plans, for someone, that's middle-aged, earning well, and wants to save. It's a lot of saving, okay? So we'll say that this person is in the public employee retirement, and so 10% of their pay goes in to go to that. The employer chips in 14%, but again, we're only counting what they get a deduction for and are saving in our examples here. The 403B, they're allowed to put in $23,500. And let's just say that they choose to do that pre-tax. So they're going to get, this deduction right here. And we're going to say that they also want to max out their deferred comp. They've got the cash flow to be able to do it. They're allowed to put in another $23,500, and that's Roth, meaning that it'll be tax-free later. Now, you could say, hey, I'm going to make more in the future, or I think taxes are going to be higher in the future. You could do both of these Roth. It's just in this circumstance, we wouldn't get a tax deduction of $41,000. We would minus that 23 from there and only get the 17.5. So you're going to pay more taxes. It's painful to do more Roth, but in the future, you may be very happy with yourself that you did that when you have a bigger tax-free pot. And if you're farther along, you may want to consider that. Consider it seriously, doing more Roth, because I see it so much where people are like 80 to 99%, pre-tax savings, because you're usually going to get forced into it on the pension, Social Security. If you do ARP, ORP, the 401A, almost all the time when the employer's doing their match into your plans, or like that DC plan, like I said, like you'll see at a lot of hospitals and what. So it's all going to be pre-tax because they want that deduction from there. And in the past, they've not been able to shift the taxes to you, so they're not going to pay them, right? So you end up with a lot of pre-tax. And then in this circumstance, say this person was married and their income was under the limit, so it's like what, 230 some thousand. If you go over that AGI limit, then you're going to get limited from being able to make IRA, Roth IRA contributions. They cannot limit you from making, no matter how much you make, from putting into your employer sponsored plans. They can only limit how much. So everybody gets the same amount unless, like I said, you get over that age for catch up. So in this circumstance, this person was able to put away $71,500 and get tax preferences from that, a $41,000 deduction off their taxes, and then $30,500 that they were able to get into a tax-free account. And this may not seem like much, but those tax preferences, if you're paying 20 to 30% taxes, depending kind of on your state and what your total household income is, to get that tax-free growth on this, this person's probably going to work another at least 20 years, and then they're probably going to withdraw off of that for probably 20 or 30 years. So, that's 40 to 50 years worth of tax-free growth. That's so much more money than if you just save that in a non-retirement account. And here, the one thing I like to tell people, because they're like, what should I do, pre-tax or Roth? And so the real thing is, if you think your taxes are going to be higher in the future, then you want to do Roth. If you think your taxes will be lower in the future, you want to do pre-tax. Let's say your taxes are 25% right now and they're going to be 25% retirement. It does not matter which one you do, okay? Because after your money will grow into more in the pre-tax, and after you take that 25% off, you were able to save less in the Roth, okay? Because after tax, but then it grows to the same limit and you don't have to pay any tax on it. So if your taxes are the same, it's not going to matter. So it really just is kind of a judgment call on your part of where do you think your taxes are now versus the future. Okay, they're both good and generally better than saving in after tax or non-retirement accounts. So let's look at another example here. Did I go too far? No. Okay. I'm going to show you this one. This one's say a 60-year-old making $250,000 a year. Okay, and this one will say this person did the ARP. Okay, so in that circumstance for state teachers, 11.76 of their money from their salary would go into their ARP account. If you're not used to this, it's like they have just another 403b or 401k account in addition to their other accounts. Then they're allowed to max their 403b for their participant contributions with the catch-up. So that's $34,750. They're also allowed to do that with the deferred comp, the 457. And so you can see I did this one kind of the same, of where they kind of split their money between Roth and pre-tax. And then they're allowed to get all the way up to that. They're allowed to get up to that 70,000 plus the catch-up. So they were allowed to do 46,500, which adds up to 81,250. Okay. And some people was like, why do after tax? What is after tax? So after tax is you're allowed to put it in kind of like Roth after you pay the tax on it. It gets to grow tax deferred. And if you don't do anything with it and you just withdraw it later on, then you have to pay taxes on the growth. Okay. So that's after tax. However, a lot of plans have enabled after tax contributions in plan Roth conversions. And if your plan doesn't offer the in-plan Roth conversion, you can roll over the after-tax part to your Roth IRA and the growth and the pre-tax part of your 403b into your pre-tax, okay? And so this is very powerful. You can get a lot more money into Roth this way. And then they were still able to make their $8,000 contribution because they were able to take their income down so much with the pre-tax, and that's without their health insurance deduction, and if they're doing it like their HSA contribution or FSA or whatso. And so they were still able to get their Roth IRA contribution in. So Roth, so they were able to get a $64,150 deduction on their taxes to save into their retirement accounts, get straight up $42,750 into their Roth. And then they made this 46,500. And what ends up happening, you have to, if you're working with us, we help people plan this, or you have to just kind of be on the ball. Each year, you just kind of have where you implement everything. And at the end of the year, beginning of the year, whatever your timing is, then you just do a once a year conversion, and you're allowed to convert that after tax into your Roth. And let's say that 46,500 by the end of the year, it grew to 50,000, then you would owe taxes on 3,500. Okay, you would get a 1099 to pay taxes on that for that Roth conversion, but you got 50,000 into Roth, and then the future growth you get to keep tax free. Okay, so you would want to just almost like conveyor belt, keep doing this with the after tax, as long as you have the cash flow. That is the trick to all of this. You have to have the cash flow, to be able to miss that much of your money. Let's say this person had paid off their mortgage and their spouse, maybe was an admin at the hospital and made 50,000. And so then still, their take home after taxes might still be like $6,000 or $7,000 a month, which is plenty enough for them to live on. And they're going to be really secure in their retirement. Or maybe they were late savers. I got a lot of people that are making good payments and they pay down a lot of their stuff, but they didn't save a lot. And so the catch up's real. You got to catch up, right? So let's keep moving on. The other thing, that I would like to mention too is, unfortunately, when I have been in this industry for, pushing towards 25 years and working with people, the plans used to be a lot better in a lot of ways. Of course, they made improvements or whatso, but unfortunately, you live in this country as well. Our country is litigious, and a lot of our employers are kind of optimizing for simplifying things, lowering costs of themselves, and big one, limiting their liability. And there have been multiple there have been multiple class action lawsuits against employers to where either the fund expenses were not optimized and the employer was kind of letting the investment company or what's so charge too much. And so, of course, your employer is a fiduciary to you. They had to put your interest before their own, right? And so that's a big no-no, that they weren't shopping and getting a better deal. And so that's very reasonable, right? They should do that, and they should have gotten in trouble for, letting the people get fleeced. But the thing that is also happening is they used to have these plans, and if you still got it and you're lucky, to where you have like 25 to 200 different fund choices, and you can invest in small value and weird bond funds, and you could even put some in precious metals or emerging markets, et cetera. There used to be good plans. However, people sometimes do dumb things, and some of the participants would be like, well, I'm just going to put all my money 75% in gold and 25% in emerging markets small cap. Like, that's not very good, putting your eggs in different baskets. And then later on, people would say, well, I didn't know. Nobody educated me. And since I didn't do good and I lost money, I'm going to sue the employer. And so, kind of the building the plan for the weakest link, they've limited the options down to where you don't have a lot of choice now. You usually have your target dates, which are those, target 2040, target 2030, when you're going to retire. And then they kind of do the asset allocation, eggs in different baskets inside of there. And then there's usually like 5 to 8 funds in there, which are like large US, small US, sometimes a mid, a developed international, sometimes there's no international at all. And then there's like a core bond fund and like a guaranteed type fund. And that's it, and sometimes it's just like a small index fund. It's not even like small value versus growth. Those are hugely different investments. And so you really have gotten limited choice inside of here. And to me, for those that would like to do better or hire somebody to help them do better, that's kind of sad to me, because you are kind of missing out. Now, the last 10 or 15 years, it hasn't been a big tragedy, because a lot of the large US fund that they'll put in there is the S&P 500, and that's been a terrific investment. It's been one of the high flyers, besides if you were straight up in large growth tech type stuff. But again, you got to realize things go in waves. If you look at like the 15 years before that, the S&P, didn't even break like 4% per year, right? Because of all the tech bust and that series of things. And so just getting into the S&P the last 10 years or 15 years, everybody now is just like, investing's easy. You just buy, the S&P 500 or the Vanguard Total Stock Index and you're good. But if you had done that 30 years ago to 15, then you would not have done very well. And if you were right at the period of this beginning, 15 or so years when things started to take off for it, you would have looked like a huge dum-dum for saying just put all your money in the S&P. So again, it's very easy for investors to jump on the bandwagon with what's done good the last 5 to 10 years, and this has worked out well. There's more than likely, nobody knows the future, but more than likely, there'll probably be an extended time period where small caps and international, even bonds, come back and do real well, and large US really underperforms. And if everybody in the 401k, 403b for comp is concentrated in large US like the S&P, it's going to be bad. It's going to be bad for people's retirement and how early they can retirement, and they're not going to run out of money, etc. So they've reduced your investment options. They're limiting choice, to just kind of big brother everyone. Now, on aggregate, the reason that they do it is because these consultants, how they're outsourcing their risk, and what's told them, hey, this is the way the most people are going to end up the best, right? And so if you're more sophisticated or have someone that helps you build a sophisticated, they're really kind of hurting you. And they're very focused on low cost versus good price and value. Okay. So just kind of understanding the market, you've probably seen this in the last 5 to 10 years where your plan changed. And then when you look at the investment options, there's hardly, if you didn't pay attention and you just ended up in a target date, again, this is probably what happened. Okay. Again, throw your questions in whenever you think of them. I'm going to hit them all in the end, but I don't want you to forget. I've done that so many times in these webinars that I've been in. So you've got a question, throw it in there, and then I'll hit it right at the end everyone. So it's going to get addressed. So brokerage windows, what are brokerage windows? So one of the things that's happened is Fidelity really pioneered this back in the day. But when a lot of these plans started getting sued and started making some of these decisions to go be more simplistic and limit liability, they said, well, Fidelity's like, well, we could give the option to the sophisticated people to still have lots of other investments in there. It's a little bit complicated for them to set up and to use. And, that may not be a horrible thing, because then that'll make it to where not a ton of people try to go do it. And then they'll have to like sign this extra limited liability, and that it could be more expensive and riskier and blah, blah, blah. And so this came around, and it's kind of a double-edged sword in the fact that it is a good option to have, but it has some potential downsides to it. Okay. And so the way that it works in general is most of the time you will get online in your 403b or deferred comp, or if you're watching this and you got a 401k, and you'll have something in there that says open a brokerage link or learn more about it. You go there, then you can open the account. Once it's open, you end up with two accounts. So it's almost like having a double car garage. Right? So you have your regular plan that they designed inside of that garage, and then you have the brokerage link. So it's two different accounts that send under the tax shelter of the 403b garage. Okay. And so you're going to have two accounts, and then you're allowed to move, depends on the plan. The sponsor or your employer gets to pick. You're allowed to move somewhere between like 50 to 100% into the brokerage link. Okay, or brokerage windows. The brokerage link is kind of Fidelity's kind of proprietary term for it. But brokerage window is what it is. Brokerage link is what Fidelity calls it, and they're the main propagator of this. More people have gotten into the game since then, like Schwab and Empower and TIA and Vanguard, but still most of the time where we see people utilizing it is going to be in Fidelity, and then probably second Schwab. Schwab, they call theirs PCRA now. Okay, but then you're going to have, when you want to do stuff, you got to kind of like sell out of your investments, move it into the investment option that is the brokerage link. The next day that money will show up in there, it'll be in cash, and then you have to pick funds inside of there. And you really want to think about it like it's one account, even though it's two, because you want your eggs in different baskets wisely. And so you're going to try to make the two accounts be able to pick up each other's inadequacies to make a better portfolio. And so I already talked about that. The good thing about it is potential for higher returns to get access to some of those things that the sponsor knocked out of the plan lineup. And so, like we had talked about, you're going to get expanded investment options. It really depends on the provider, and even the sponsor gets to choose. I mean, if they use Fidelity's and just say, yes, we'll just use your default thing, I think it's over like 10,000 now. So you can do a lot of things inside of there. A lot of the funds and stuff can be pricey. So you got to watch out and like really look at like, what am I buying? What are the costs of this? What are the alternatives? So do the due diligence on that. It's increased complexity. So like I said, it is more time consuming and administratively complex. So, because let's just say you have an emerging market component in your brokerage link, and let's just say the next 2 years it does phenomenal, like Nvidia and some of the large tech stuff did the last 2 to 5 years. Well, it's going to get bigger, and you might need to take some of that money off the table. So you're going to have to sell that, and you actually have to do orders in the brokerage link versus just the percents that you're used to in your 403b or whatever. You're going to sell that, and then it's going to settle, and it's going to turn into cash. Then you got to take that cash, transfer it back into the traditional, or the part of it that you want into the traditional part of the plan, because maybe you're using the S&P 500 in the core bond fund in there. So you could see this is like a 2 or 3 day process just to make one, what you would think is simple, which is to sell high and buy low, right? It makes it a lot more complex. And then it just takes due diligence. So you need to know really what you're investing in and what part of your portfolio it makes. Is it the best one in there for how much it costs? Sometimes there's trading fees beyond just what the internal fees are. Some of the funds will trade for free. Some of them that are lower cost might have a ticket charge of like $10 to $50 per trade. And so you really got to make sure like, oh, this one's 0.1%. But if you got a smaller 403b where you've only got $10,000 in the brokerage link, and the fund you picked is like $25 a trade, and you've got to rebalance a couple times a year, or scoot stuff over and buy again, you could end up with being way more expensive than the 0.7% fund that traded for free, right? So you got to keep things in perspective. It does make it more complex, and you got to think about it in your situation, not just in general. Okay. So again, throw those questions in there. If you got them, we'll hit them. So best practices are things to avoid. Avoid chasing returns. I mean, this is half the reason that they are trying to big brother these plans. Is it's real easy to just look at the 3, 5, and 10. I can't even tell you how many people I've talked to the last 2 decades that'll be like, oh, well, the 5 and the 10 year, these are just the best funds. I mean, if you do that right now, you're going to put all your money into large US stuff, generally large growth, like tech type stuff. And if you have a reversion in the long term, when you look at rolling 25-year periods, except for like the last 10 years, large growth tends to do right around 9 to 10%. And right now it's like over 15. So it's over 50% higher than its long-term, like traditional rate of return. And I don't know, maybe this is the new normal. You know, maybe they will continue to be everybody else forever, but more than likely not. You know, that's one of the sayings we have in our industry is the most dangerous words an investor can believe is it's different this time. As soon as you start to get on the bandwagon for something like that, that's generally where at some point where you're going to get pelted by some kind of bubble busting or whatever. Okay. And so in that respect, you just got to be careful. Most people do not look past the 10-year rate of return. What's its 15? What's its 25? You're like, I don't know. This ETF was just established 2 years ago. How am I supposed to know? You could look up exactly what that benchmark is to that. So say it's like a small cap index, and you can look up the Russell 2000 and just see what small caps have done over the long term. And what is that difference from where we are now? Okay. And so just be careful. Right now, I can see a lot of people chasing a lot of tech stuff and get them burned in the next 5 to 10 years. And if that's in a side account that is like your speculative account with Robinhood or whatever, I mean, it sucks to lose money, but who cares? But if it's your whole retirement, that can really suck and mess up your family's life of what you want to do and what you worked hard for. So be careful. You know, it's kind of, you know, with more power, you have more responsibility, you know, not to put all your eggs in one basket. Prioritize the cost. So like I said, it's real easy to just look at funds that have done better and they might have concentrated more in the thing that did well the last 5 to 10 years, but maybe their fee's 1.7%. And you've got something that's a smart beta kind of index fund that's 1% per year behind them, but maybe it has a little bit more value in it, but it's at like 0.35%, very similar type investments. And statistically, the lower cost one, if it's very close in the type of fund it is going to do better, even if it's behind right now. But a lot of people will just look at the return and just neglect the cost. But when you look at fees and reducing costs, it is almost the only variable that every time you control it, you raise the rate of return, other variables excluded. So it is a very important thing. It's not the only thing. I was just criticizing sponsors for only looking for cheap things. You got to look for value. You got to look for good things that are a good price, not necessarily the cheapest, but don't be a sucker and buy the most expensive thing just because they're doing good the last 5 to 10 years. Okay. Proactive management. I mean, especially when you do this, you got to look at your stuff every year. And if one, you know, of those eggs in the basket got too big because it did good, because you have more, you need to take some money off the table and buy something low, right? You need to look in there to see what the fund lineups are, where things have changed. There are people that haven't really changed their portfolios in the last 10 to 15 years. And there may be way better investment options in there that are just as good for half the price, or their S&P 500 fund, they put 50-50 with the bond fund in there, and now it's like 80-some%, and they're close to retirement, and they don't even understand how aggressive they are. Especially if we get some kind of reversion to the mean where large cap doesn't do good the next 5 to 10 years, and they get pounded right before retirement. That would be bad. And then this goes right along with it. Avoid concentration risk. You know, I don't know, Fidelity's talked about it multiple times, but talking about putting, you know, crypto in there. You could have the crypto like ETF type thing, and somebody saying, I'm just going to put 100% in the Bitcoin ETF. You know, I like digital assets and what's so, but you got to be responsible. You don't want all your eggs in one basket. You want things in different things. And half the reason I like them is because I do think that blockchain is a very good technology. And if you invest in the right ones that actually have, good use cases to like actually do things. It's not like a Ponzi scheme type thing. The side effect is they have very low correlation to a lot of the other things. So they go up and down at different times in the stocks and bonds, which that's one of the main reasons we put eggs in different baskets. So that's beautiful. So to get some good growth in a way where you can harvest it and buy some of the other things when they're down, right? But if you're just concentrating in there, it's less investing and more gambling. And generally with your retirement, your kids' college and different things like that, you don't want to gamble with it. So what can you do? You can do some, and don't get put out. I'm naming everything, and not everything's got to be for you, and you got to do it for different reasons. But you can do values-based investing. We do this for a lot of our clients. So whether it be ESG, which is environmentally, socially conscious, good governance, it could be religious values, faith-based investing. So biblical, Protestant, Catholic. We even do halal, which is Islamic faith-based investing. And so these are very important. And over time, they performed very well. So you can align your investments with your values and still make very good money. Momentum focus strategy. So you might want to say, hey, I believe that the future is a little bit more tech and growth oriented. Instead of being balanced, maybe I want 60-40, more momentum. And there are different ways to do that, but you could do that. You could hire a manager to do that. Alternative asset exposure. So like we talked about precious metals or commodities, cryptocurrencies, you may want more exposure to that. Again, I say, be careful. I wouldn't concentrate, but being able to get that in there, you almost are not going to be able to do that in a traditional 403B or deferred comp or 401k anymore. Or you may want some customized asset allocation, like Dolly's all-weather portfolio that tries to do a good return, but it works well in all kinds of different environments and produces decent returns even in a sideways or down market. So there are different things. Just be careful. You shouldn't market time. You shouldn't be switching back and forth. That's generally a bad strategy and low probability of success. But if you choose a strategy that has merit, that has academic statistical research to it, and you're disciplined about it, there are lots of different ways to win, and that's up to you. And this empowers you to be able to do that. And so, when you're expanding, you could tap into small caps. I'm just noticed more and more, it's very difficult, to get access to mid caps and small caps. And if they do have them, they only have like the mid cap index fund, or small cap index fund. I mean, that's very different than having an actively managed small cap value or mid cap growth. Very different strategy. And you may want to have all four. You can have a mid value, a mid growth, a small value, a small growth. You've got those eggs in different baskets that you can buy low and sell high. And if you're disciplined about it, that absolutely can work very well, rather than just having that blend index fund of everything. Explore international opportunities. So, most plans, I can't believe how many I've seen that don't have an international option, but they generally just have one. And it's like 80 to 100% developed. So only in Europe and Canada and Japan and Australia. And it's just like half the reason of having your eggs in different baskets outside of the United States is to get something that's different from the United States. Not everybody's in love with China right now, but China and India and Brazil and maybe one day, again, Russia, but we'll see. In the Middle East, I mean, there are lots of opportunities around, and, emerging market small caps, emerging market debt. Instead of just core bond, you can have high yield bonds, you can have emerging market debt, you can have international debt, you can have some of those things that are not currency hedged. So if the dollar was to lose value, you would get extra rate of return in those. There are things that are variable rated, like floating rate bonds and versus just having one core bond option, which is really conservative, which is not bad. You need it. Absolutely, you need it. And then you can incorporate alternative investments like we talked about before. So you can find professional help. That's what we do. We're kind of few and far between people that specialize in working with universities and K through 12 and using the brokerage link, it's hard actually. I'm actually thinking about starting a technology company to help build this for other advisors to be able to do it faster, more efficiently, standardize it, report on it better, be able to, like we said, treat those two accounts as one. Or like when we got clients that have got the ARP, their full 3B, and their deferred comp, plus the brokerage links, they may have 415 in plan, plus their personal stuff. How do you put all that together and keep track of it and make sure that all those different investment companies are treating you right and you've got the due diligence on everything you do? And then you can find people that do different things. So again, a lot of my pictures are AI generated. I hope you like them. I told them to do me like a Wall Street He-Man for this one, but as a leveraging low cost providers, generally it's going to be Fidelity or TIAA out there for full 3B, deferred comp, ARP, ORP, etc. If you really want to utilize the brokerage link, Fidelity really has really has an advantage on that. TIAs try to do it, but they have a very tough to work with integration with Pershing, so it's still doable. It's just hard. I love TIA. They're probably one of my favorite investment providers in terms of being a nonprofit for faculty and staff, and they give great deals in terms of how they build their products and look out for people and put good investment options in there. But again, it's just not quite as good. And the annuitization is great with TIA, but it's just not as good for the brokerage link. And it's not like you can't do a lot of your younger with Fidelity, and then later on you're allowed to switch providers a lot of times, switch over and put some money into TIA if you like some of the features that are available in their very low cost annuities that you can get guaranteed payments out of, et cetera. But many people should have a professional RIA if you want to do some of these things. If you do, someone like us, an RIA is a registered investment advisor, it's ideal to have what we call fee billing. And fee billing just means that, most advisors are paid as like a percent of the account. So say, we charge 0.5% at our eRebel level with how much money you have with us, then we can take that straight from the full 3B or straight from the ARP. And considering that a lot of that money is pre-tax, it's almost like you get a tax deduction when the fee can come straight from there. Unfortunately, it's not your choice sometimes. The employer just doesn't allow third-party fee billing. And so some of our clients pay us out of pocket to do a lot of this work for them, which is not a big burden if you have the cash flow or you have a non-retirement account to where that can come from. And it can be worth it a good bit in terms of the work that we do and the extra diversity in planning and tax work on top of the investment stuff that we do. So if you look, I just gave you a little bit of example because a lot of times you have multiple providers. And so you can see, and I averaged, especially over here to the high side, I'd say these two are probably about right on from what we see. This might actually be a little bit low, but again, I'm not trying to make the numbers look in our favors. This is high for our clients, but again, I'm not trying to make it too much in our favor. And so you can see how much does it cost if you're with one of the providers that should give you an advisor, or what's it'll be like VALIC or AXA or Lincoln or Voya. They'll have a platform fee, somewhere between 0.25% to 1.5% on average. With the universities and stuff, it'd be 1%, maybe K through 12, and some of the smaller municipalities, it'd be higher. But it will just say 1%. And then the fund expenses. So when you're picking the different funds inside of there, let's say on average, it's about 0.7%. They have a big range inside of there. But generally, most of these companies will put what's called 12B1 type fees inside of there. So where the fund companies are kicking back to them too. And so the minimum on those is usually like 0.2%. So it can't go much lower than that because of that fee. There's no advisory fee because everything gets paid for out of these two. And so let's say it's about 1.75% per year. If you do it yourself, so just the DIY, and you use one of these two low-cost providers, you're generally not going to pay a platform fee. With TIAA, if you're a university or school, then it's usually like 0.1%. And then the fund expense in there will be, a spread, but a little bit lower. Okay. Some of the Fidelity you can get down below 0.1%. I probably should have made the range go a little bit lower, but on average, I do see people paying about, 0.5 to 0.6% with the funds that they pick on average inside of there. And then if you add someone like us on there, the cost can be anywhere between 0.25 to 1.25. Usually on the university plans and stuff, a lot of the universities have capped the fees at like 1%, so that no one can, so that they won't have anybody overcharging too much to their employees. And so then you've got your internal expenses, which is a big range of cost of the funds, especially with the brokerage link inside of there. But let's just say on average between all the RIAs about 1.5%. I would say our fund expenses on TIAA tend to be, right around 0.35 or so, and with Fidelity about 0.11 or so. And then you can actually see our actual fee expenses, depending on how much someone has with us. Say our average client maybe pays us around 0.6 or 0.7, depending on how high a level they want to be and how much extra work we're doing. But still, we do investment management just at these levels. So comparatively, you might be down to other advisors for what they do to about 0.5%. Okay. And so given that, if you're Fidelity and we optimize the funds and it's down to 0.11 and 0.5% with us, you're not much more than what the average person's doing over here, and almost 1% per year behind this. And we do a lot more stuff than they do. So there are some good deals out here to get some sophisticated help without it costing a lot more. So should you get out of your plan, make sure you don't lose any benefits you need. So like I said, with TIAA, you have the ability to annuitize. You might have different investment options, or you might not be totally vested yet, or you can retire, between 55 and 59.5 and have tax-free withdrawals or tax penalty-free withdrawals. And if you roll it over to an IRA, you could lose that. So again, you got to make sure you don't lose any of those. Make sure you look at the cost differences, compare what your investment options are, and any impact on taxes and penalties. Some of these providers will charge you a penalty to get out. So you got to make sure that you're not going to hit the penalty. These are generally some of the things, I'm running out of time, that would be very practical time periods of when you can. If you're separated from service, you can't. I've seen people that have 10 or 15-year-old stuff still in an old plan that sucks, and they could have rolled over to an IRA, reduced costs, got better investments, etc. If you're over 59.5, even if you're still working there, you're allowed to roll over. So especially if you want help and they don't do fee billing, this is a great option to be able to roll the money out and get kind of those tax preferences to pay somebody to help you. If you're divorced, you're usually, after everything goes through and you have this domestic relations order, allowed to roll your part of the 401k or 403b or deferred comp out. Of course, if you inherit and someone has died or whatever the case, then you have a lot of options as well too. And so we already talked about a lot of the reasons of different things that you can get. I would say on here that I didn't hit as much fee optimization. So like I had mentioned before, with being able to use that fee billing and get some tax preferences. And then we help our clients with commission-free annuities and stuff like that. So if somebody wants something more conservative, or a guarantee, or a guaranteed minimum income, or they want an indexed annuity, they're not always my favorite things, because even when we try to shop and get our clients the best deal, they're still kind of expensive. But when you want a guarantee or to get someone like us that doesn't take anything from these people to shop it and get you the best deal, can absolutely do that. And you're almost never going to find those in the plan. Okay. This is just kind of our plug. Check out our website. I'm going to skip through it because I really want to hit some of your questions inside of here and not leave them. But check us out. We're a lot different than most of the other investment companies. We don't lock people in. So even if people just want to try us and then it doesn't work out, it's real easy to just go back to DIY because we use the companies that are for DIY. That's our team right now. And you can learn more. I'm going to go over the questions. If you want a complimentary appointment, you can just scan that QR code, pick one off of our calendar, and we'd be happy to talk to you and see how we can help you out and at least give you a little bit of free info, even if you don't decide to join us. Okay, first question here. Could a 457 plan be a good tool for bridging the income gap for early retirees who leave early? That's a great question. So thank you. I would have liked to put another case study inside of there, I've done this a couple times. It doesn't happen a lot, but if I've got somebody that's young, that's got the cash flow to be able to save, and say they work for government or where they can use deferred comp, and they want to start their own business, or say like a doctor that works for a medical center wants to eventually start their own practice, then you could save a lot in a deferred comp, because deferred comp is not really a retirement plan. Okay. A deferred comp is deferring your compensation to the future when you don't work at that employer anymore. And the real reason that it came around is really for firemen and police, because they tend to retire earlier. The pension lets them, and that's fair, right? They have a more dangerous job than us. So if they make it a certain period of time, they should get to retire earlier, like 52 or what so, right? But if they were in a regular plan, they would get tax penalized for withdrawing too early, right? So the deferred comp doesn't have any tax penalties, and it is just deferring that until you don't work there anymore. And regardless of what age you are, you're allowed to take it out tax penalty free. So like in that example I was just giving you, somebody that wants to use the money to start a business and they save a lot in the deferred comp, say they were getting paid well, right? And they were paying 25 or 30% tax, but in the first 2 years, they're not going to make much at all when they start their business, because a lot of businesses lose money in the first year or two. So you almost be able to like get a tax deduction when you are making good money, grow it tax deferred, and almost get to take it out tax free to start your business. Like, boom, that is beautiful, right? But that's a more extreme example of what you asked. But absolutely, just like I said, for police and fire, when you retire early, then you can absolutely use the deferred comp. And there are the penalty that comes on there is called a 72T penalty. And there are various exceptions for that, for disability, for substantially equal payments. We've used that multiple times where we got to bridge the gap for income. A lot of our clients that have non-retirement savings, that's easy peasy. So we just use that to live off of. And to make their taxes get spread out more efficiently, we'll do Roth conversions, and then they'll hit the period where we can withdraw without tax penalties, and it's elegant. But again, a lot of these things you have to, work out the plan and the math basically to look at all the different permutations, and then how does it work out optimally for that person based on what they save, what they have, and what format, and what their risk tolerances for how aggressive or conservative they want to be, and how they want to use their money. It's a complex system. Last question. If you have any more, throw them in here, and we'll respond to you personally. So last question here: is there anything unique regarding estate planning implications for 403B and deferred comp plans that are similar, or are they similar to other qualified plans? Generally, they're going to be pretty similar in terms of features of leaving them. Most people, unless something happens to them prematurely, don't end up with money in their 401k or 403b or deferred comp. At a certain point, just like we were going over at the end, people will consolidate to their IRA or what so, just because of either cost optimization or getting access to more diverse or better investments, or the opposite side of things. They get older, or things change for them, and they want something that's more on the insurance-y side of things, to where they get certain guarantees and what so. So people do tend to gravitate to the IRAs. People that I'll see hold their qualified plans a little bit more will be like doctors and high net worth people that want extra protection from like liability or getting sued. Doesn't quite apply as much to 403Bs and deferred comp. But again, there's lots of different variations out there, but most 403Bs and deferred comp are not ERISA. And that's the extra part of the law about retirement plans that protects them more legally from like lawsuits and bankruptcy and different things like that. And so in that respect, it's not as big of a thing on the 403B deferred comp versus the 401k. But some 403Bs are ERISA, and it's not 100%, but it's a pretty good acid test. If your employer matches into it, it's probably ERISA. Okay. If they don't, it's probably not. But again, it's not 100%, but it's likely. if that's the case. So we hit right up on time. Really appreciate you all attending this. Please join us for some of our future ones. If you're watching this in the future, still send us your questions. I answer those usually with a video response, so that you get a very good response back to the things that you're interested in. Hope this helped you. And if there's anything that we can ever do for you in the future, let us know. Right now, we're helping a lot of our clients with their tax prep and doing Roth conversions and what so. Be happy to help you if you're working through any challenges with taxes or what so as well. So have a super rest of the week and happy spring, and we'll talk to you soon or see you next time. Bye-bye.